Hi, everyone. Thank you for coming. We're going to start 12 o'clock sharp. Really, thank you for coming and being here. This is our 13th episode of our webcast and our in-person events. Yay. So usually I have my co-host with me, Sarman, but he's not feeling well. He's actually in the corner somewhere. We needed him to set this up. He really wanted to be here, but we didn't want this to be the super spread event. Um, we'll do this without him. It's a little bit awkward for me because he's usually getting things going for me. And so we're here to discuss taxation and the difference between taxes at a personal level versus corporate, as well as investing in public markets or private businesses. Thank you, Jonas, for joining us from Segal. So he's a tax expert, and if you are going to ask questions, which I hope you will, just don't talk about yourself personally. You could say, my friend has this tax question. You don't know who's in the room if CRA is here. But please do ask questions. We're going to go through the presentation shortly, but before that, I just want to, there's a lot of new faces in the room. Just go over what PEGate does. So we invest in private businesses and generally smaller businesses because there's very few professional investors competing with us. Therefore, we're paying very reasonable multiples, and we bring those opportunities to our investors, through our platform. And we're quite unique. We're not a fund, and you're not stuck in that investment, and you could trade that investment through that platform. And what we do also is organize these events, these learning events, and for people to get to meet each other. I'm going to introduce the team. So some of you know Sarman. He's one of our earliest investors, as well as he joined us a couple of years ago as a partner. He heads our investor relations for PEGate. Then we have Jack, who's here. He was here last year. I don't know if you saw him, those who were here last year. So last year, actually, he had an offer at Deloitte. And after the event a year ago, he asked if he could join us full-time instead. So welcome, Jack. He does everything pretty much and keeps us in check. Then we have Tamara, who runs our admin and for some of our investors here, writes the checks. So Jean, that was, thanks to Tamara. Yeah, he got a check today, yay. Yeah, so, and Jean is one of our earliest investors as well. And the deal he invested in, and I'm gonna caveat this, not every deal will be such as this one. It's a phenomenal return. I believe with the check today, he'll be at over 50% IRR, assuming today's valuation. We just had a transaction last week that closed. It took some time, but one of our employees in a portfolio company ended up buying one of our shareholders out, a single shareholder. So it was a full exit for him. His IRR was over 48%, almost 5 times his investment. And the reason he did it, we had an offer by PE fund, which our partner and our staff didn't want to work with them. They preferred to work with us. And one of the employees stepped up and said, I'll match that offer. So welcome, Jean. And next, we also have Ellen, who's not here. She's the go-between between us and our platform, which we continuously develop. Next, I want to introduce Kevin, who recently joined. I'll let him introduce himself.
Hello, everybody. Very, very nice to see a lot of familiar faces and new faces here. So some of you know me. I've been in the kind of private equity, small business acquisition space for over 2 years now. However, when I started my search and my journey for buying a business, PEGate was one of the equity partners that I lined myself up with. There was obviously compelling reasons that we're going to talk about later today about why PEGate made so much sense for me as an investor. But ultimately, from going into kind of an independent sponsor model, looking for my own business, I couldn't resist jumping on board with the team at PEGate to be basically leading everything to do with growth, scale, partnership. So a lot of the people in this room I've met over the years, I was very, very glad and happy to be able to receive here and to invite to this event. The goal for us is really to bring businesses, to bring investors, good businesses run by really, really qualified and great operators. And part of my mandate personally is really to develop that network and that orbit of sponsors, brokers, bankers that all come together and coalesce to form really, really good investor returns like this portfolio company that Ara mentioned. So
thank you for being here. Now we're going to talk about tax. Isn't that exciting? Are you guys excited? So two things may happen after this conversation. One, you may want to invest in private businesses, not necessarily through PE Gate, because you're going to see all the tax benefits. But the other one is you may want to break ties with Canada after seeing all the taxes that you're going to pay and the benefits of not being a non-resident. But yeah, so welcome, Jonas. Quick background about Jonas. He's a senior manager at Segal. He loves working with clients to tax plan from startups to all the way to succession planning. And he's an avid marathon runner.
Yeah.
And where's the most interesting place that you've actually ran?
Well, I just ran the Berlin Marathon. I just ran the Berlin Marathon this year, and that was pretty spectacular. Going to Germany was a great experience. Not something I've ever contemplating before, but seeing the fantastic races that they put on was just a terrific experience.
Excellent. So we're going to ask you to hold questions till the end because we're probably going to cover them, but I'm sure you're going to have a lot of questions. So let's get started. So what we're going to cover today is tax benefits of investing in private businesses, utilizing your lifetime capital gains exemption. Any of you have used the lifetime capital gains exemption in this room? One person, two, three, okay. Anyone know what the lifetime capital gains exemption is? I think a lot of people, we had this presentation, very few people do. We'll cover that. New capital gains rules and as well as non-resident tax planning. So let's get started.
All right, thank you, Ara. And thank you for the PE Gate for having me in. I wanted to first talk about some preferential tax rates, and I think some of the products offered by PE Gate will give you better returns. The first one is dividends. Dividends are an interesting return on investment because you get a bit of a preferential treatment by getting the dividend tax credit. Normally, you earn income from your investments and you pay your marginal rate. And if you're at your top marginal rate, you could be paying almost 54% in Canada. The dividend rate on what we call eligible dividends is about 39%. And non-eligible dividends is about 48%. However, I think most of what you'll see as an investor is the 39% rate. And then just a bit of background, the eligible dividends are usually what you get from public companies because they're paid on high rate tax, or in the investments, if they've earned and paid high rate tax on their profits, the after-tax proceeds can be paid out as eligible dividends as well. The other advantage that a private company would have is they will also often return their capital if they have excess cash that they don't need in the business, and you can get that basically as a tax-free distribution from the company back to the shareholder, and that's very handy. The capital that you invest becomes part of what your capital gains when you sell it, and the capital gains also has preferential treatment, so we can talk about that later. But having the return of capital is a great way to get back some good returns from your investment in the early stages.
So I think that's one of the biggest differentiators between investing in the public markets versus a private investment. And if it's well tax structured, that's what the return you should be getting. So if you invest, we're going to give some numerical examples. So if you invest 100,000, say, you should not be paying tax. You should not be receiving dividends on the first 100,000. That should be a return of capital. So that's one of the biggest advantages I would say compared to public markets.
And then just to contrast that, if you're investing through a corporation, corporations pay what's called Part 4 tax on dividends, and that Part 4 tax is also around 38%. It's a temporary tax that you pay the tax scheme in Canada has a concept called integration. And integration is trying to say that whether you earn income as an individual or through a corporation, you end up the same. So that temporary tax is refunded when you eventually pay yourself dividends. And those dividends you pay yourself could be at that 39 to 48% rate. But what was also interesting is if you have a more sizable piece of an investment, and it's more than 10% of the votes and values, you could be what's considered a connected company. And that connected company who has a significant amount of influence because you have over 10% can actually eliminate that Part 4 tax. So you could actually keep the money, the entire money, into corporate dividend in the company, which you could invest in other things without having your 38% tax.
So this complicates things a little bit. So if you're an individual who could invest personally versus through a corporation, there are advantages of investing through a corporation. And so this is the question we normally get from investors: do I invest through the corp or personally? So we don't know the answer to that. It depends on the situation, but you have to weigh the lifetime capital gains exemption versus this the refundable Part 4 tax that is only eligible for corporations. Is that right?
Yes. That
you own more than 10% in the investment. So these complicated tax rules keeps everyone busy, lawyers and accountants busy. And as my, have you heard of Stanley Lakin?
Yeah.
Yeah, so he's one of my professors at Waterloo. And one thing he would say is tax is a microcosm of life. And if anyone in the room and the student can prove otherwise, then you'd get an A+. So basically saying tax is in everything. So people would say love is not tax, but it is. You got to buy a wedding ring, whatever. So it is. And the other thing, yeah, exactly. And the other thing you would say is, if you could get away with it with a straight face with a CRA, you could do it. So if you're not laughing as you're tax planning, I don't know if you've heard that. Do you give that advice to your clients?
Sometimes.
So we are here to minimize tax. So we're on your side, and whatever we do, we try to minimize it. We actually, the last transaction that we did that Jean knows about, we spent a little too much money on lawyers to restructure it. So we issued, thanks to John as well, our auditor in the room, hi John, so that we issued different classes of shares so that investors coming in at a different valuation are not disadvantaged, basically. I don't want to get too much into detail, but we're on your side in terms of managing tax. Should I go on, Jonas?
Sure. So just some considerations for non-residents. Non-residents generally aren't paying the tax the same way that Canadian residents are on dividends. Like that last was more for Canadian residents. So when you take money out of the country, you have to pay non-resident withholding tax. That's a special tax that foreign investors get to pay. In some ways, more preferential here because they're paying tax at home. So the thing that impacts what rate you're paying is whether or not the country has a tax treaty with Canada. Most countries have tax treaties, but not all do. It's just a way that Canada has negotiated better rates because of the investment business that the two countries are doing. So if you are an investor from one of the treaty countries, like the withholding rates on dividends are at a preferential 5 or 15%. And again, if you have a higher threshold, like that 10% threshold, more than 10%, then you get that lower rate because then you're connected.
And that's, again, if you're a corp or individual would qualify?
An individual will qualify.
Really?
Yeah, these are...
Okay. See the bias, guys? Non-residents versus residents.
So invest in Canada, please do. We have...
So, and that's to promote, in the government's defense, that's to promote investment in Canada. And what I believe there are preferential treatment for investing in businesses versus real estate. Is that right?
Yeah. There are different rules if you have taxable Canadian property, and we'll get through some of that as we go along. Okay. But real estate and other taxable Canadian property, like businesses that invest in taxable Canadian property, have other different rules they have to focus on.
Okay. And the and because we're going through this now, so the withholding, do you withhold 25% no matter what, and then they could claim back more?
No, so the payer company would be the person who has to do the withholding tax. It's responsible for whatever investment has to withhold the tax and then pay the net amount to the individual. It would be on a T5 or in our T5 in our slip, and they would have that as a foreign tax credit that they could claim in their country. It's basically like a minimum tax that you're paying to make sure that Canada gets something.
But who determines if it's
the
whether
rate is-
5, 15, or 25?
So you have to by default, you would think to be holding 25 unless you know it was a treaty company.
Okay.
The investor would have to let you know that, hi, I'm a qualified
Treaty.
investor, and
Got it.
you can withhold a lesser amount.
Okay. Thank you. And there's a lot more countries that have treaties with Canada. Okay. Interest income.
Yeah. So just to give interest income as a different opinion, a different set of rules. It's basically your general business income. It's treated like the same way that you had any other investment. It would get taxed at your top marginal rates. There's no deferral advantages not deferral. There's no differential rates advantages for interest income. So I'm not sure what the products have if they get paid interest, but I think most of them are given.
Yeah, we have a bit of both. We have some convertible investments that convert into, as I believe in the structure in Project Garden. So you'd be taxed. There's no advantage, basically, of getting interest income. But then there is an advantage if you're a non-resident.
There are more still. There's in fact no interest if you are arm's length from the company. So they're making sure that Canada realizes you'll get taxed in your home country at your full rate, so you'll get a bit of a break in that scenario.
So if you are at arm's length and you invest through loan, the interest is tax-free?
Yeah.
In Canada?
In Canada.
Yeah, and you're taxed in your home country.
There are various interest rules in terms of what's deductible in Canada, but that's in terms of if there's a sizable loan compared to the amount of equity a Canadian company receives, but that is a bit of a different discussion.
Oh, so it may not be tax deductible for the borrower.
It may not be tax, for the borrower.
Okay.
But that's that's if the non-resident investment is a sizable portion or has 1.5 times the equity.
Okay. Okay, great. So there's next is capital gains.
Yeah, capital gains, as you may know, has probably one of the best preferential rates as an investment return. Capital gains have traditionally been half taxable, and that's what's made them so attractive. The Canadian government has said that we want more money. We don't really believe that was such a great thing to give investors, so now we're going to change the inclusion rate to a 2/3 inclusion rate. That's unfortunately going to cost a lot of investors a lot of money. It works out to about an 8% increase in your return, or an 8% decrease in your return. You'll see on I think I have a slide showing some returns as an individual or as a corporation. And
they've complicated it further by treating individuals different than corporations.
Yeah, corporations also will pay another temporary tax when they make their capital gains. But individuals will have now it's going to be, so individuals are going to have a special $250 threshold where they can still get used the original 50% inclusion rate. It sounds a little bit technical, but if you they're giving a bit of a break to individuals only rather than corporations, where the first $250,000 you're making on capital gains, they're going to allow individuals to still use those old rates.
So it doesn't make sense if you're buying an apartment as an investment and you have a spouse to co-invest in that, so that if you sell, you each get your 250,000?
Yes, you can each get your 250.
So it's 500 total,
Yeah.
right? So you may want to do that if you feel that it's going to appreciate, you're going to sell in 5 years. So lots of new considerations. Do you think the new government that will hopefully come in will change that?
It's hard to say. I would hope so. The rules are definitely not favorable to investors. I find they're a bit punitive because it doesn't really calculate, what you've put into the company and how you've put a long-term investment into the company. But that's another story.
Yeah, the risk you're taking to. So one of the things, it's not in the slides, but as we alluded to earlier, investing in businesses, private businesses, drives economies. And investing in the public markets in Bitcoin or whatever stock, it's not going to move the needle in Canada. And that's what governments generally do. They have tax rules that promote investment. And however, in this case, when they changed the budget, they did increase the lifetime capital gain. So they are kind of saying invest in small business or in private businesses. Mm-hmm. They are saying that, but then they're penalizing others in terms of investing through corporations.
Mm-hmm. Just to talk about non-residents disposing of Canadian taxable property, the real estate investments have special rules where like a normal capital gain for a non-resident would be tax-free, but if they invest in taxable Canadian property, like the real estate ties again, then not only is there going to be withholding tax, but there's additional tax disclosures you have to make, filing disclosures. You have to file what's called a Section 116 form, and there you have to give a bit more details to the CRA, and that's due within a certain time of making the sale of the taxable Canadian property. So you have to be careful on certain investments as a non-resident to make sure you covered all your tax considerations and disclosures.
Excellent, thank you. All right, so we're going to get into some examples soon, but this is probably the most interesting thing that Canada offers to individuals. Yep. The lifetime capital gains exemption.
Yeah, the lifetime capital gains exemption gives you investors basically a reward for investing in small businesses. This allows you to make like a gain of about $1 million. It should be going up to 1.25 million, where you can sell what's called a small business it's basically like a privately owned business in Canada that has it's an active business. It's not like an investment business, but an active business, and it's primarily used and made it saturated in Canada, meaning the mind and management is in Canada. It doesn't mean necessarily that you only are selling to Canadian markets. You could sell to all over the world, but if the mind and management is in Canada, which I think a lot of your investments are, then you can take advantage of the lifetime capital gains exemption when you sell the business. There are certain conditions that have to be met, and one of it is that there's a couple of ratios that have to be met. That all the assets are used in a good business. This is going back to that active business versus like a passive investment business. They don't want you holding passive investments and which could include cash and other things in the list of assets in the company. And two of the key considerations there is that when you're selling and you're trying to realize the lifetime capital gains exemption, it has to be 90% used in an active business. So that takes careful considerations to make sure that ratio is met, because people are selling businesses, their interests at different timelines, and if that's met continuously, then they're able to recognize that capital gains exemption when they sell.
So if you are going to sell your business, you should plan ahead. One offer we made on a business. This is the second time this entrepreneur is selling their business, and he got it wrong the second time, that it was tainted. So you can't leave investment assets in the business. It has to be purely for active business. So that's something that, as a business owner, you should plan ahead, and we try to do that as well.
Yeah, and then just to be clear that it has to be held for 2 years, and it's open to Canadian residents only. And there's not like a non-resident
Component,
oh,
yeah.
yeah.
And it's the entire year you're in Canada, you have to be.
The resident rules are a bit complicated. CRA has some rulings where saying like if you were to be considered resident for 2013 to 2023, then if you were partly resident in 2022 and partly resident in 2024, then you're resident. But it's always a question of fact, and that's something you can always take a look at if this is coming up.
Okay, so we now have some examples. This is the capital gains.
Yeah.
The changes. So you're basically paying, what, 8 to 10% more?
Yeah, so you can see, it used to be a very tax advantaged rate of return, getting 26%, 27% selling capital gains. But because the rules are increasing it to 66.67%, the rate of return will go down as your tax will go up about 35%. So it's something to be aware of at capital gains. And this, unfortunately, is applying to any capital gains made after June 25th, 2024, on or after June 25th. So if you haven't sold something in the first half of the year, you're out of luck.
Yeah. Did anyone, just out of curiosity, did people change their investment strategy after this rule? Did anyone? I think that's what happened in the market. Everyone just held, right? So you only pay the tax if you sell.
You only paid, yeah, you sell. And then it's been worked out to about like a 6 to 8 year return that you're equal if you waited till afterwards. So a lot of investors said, I can keep waiting, a few more years, and then I'll be whole, based on the IRR of their own investments.
Yeah. Okay. So we have some examples. I'm going to jump through to the 5-year one because it looks much better for us. So this one is if you held the investment for 7 years, and it compares the public-private versus connected. So as well as if you utilize the lifetime capital gains. So you can see that the red part is the tax on the 7 years, but look at this. If you do 5 years, so this is the return, public company, private company, and then if you're privately investing and utilizing lifetime capital gains, you can see the IRRs are much higher. And this is and you could pay no tax, basically, in a scenario where you get your capital returned. You invest 100, you get back 100, and you sell the business with the capital gain. There are some costs involved in filing, so it's not purely free, I think.
Yeah, you have to file it. I mean, your tax returns and everything will have a cost to it too. But there's something called AMT always to be aware of. Alternative minimum tax. It makes sure that all Canadians pay like a tax at a minimum. And if your only income was capital gains in the year when you sell, then you have to possibly look at whether or not you may have a small tax cost there. If you have other income and the capital gain, the lifetime capital gain is like an ancillary part or part of your regular earnings, then you'll probably be fine. But AMT is always another consideration that your final return may not be completely tax-free.
Okay. And so let's compare so this is a 5-year investment, $100,000. It assumes it's doing well. Do you want to just walk us through some of the differences?
Yeah. So if you were just earning dividends as you would in a public company throughout the period, you would be paying that 39% tax, and that tax cost would be a little bit higher than if you got your return of capital, which is something that you offer that's advantageous. That return of capital can come back tax-free, and then this is a 7-year model. You have a couple of years of tax at the same rate you would as a public company investment.
Yeah, I think the slide is more accurate. Okay.
Yeah. So you can see that you can make a little bit more money in a private company. And of course, if you make the lifetime capital gains exemption, you save a significant amount of change on that disposition, which is very attractive.
Great. So and every scenario is different. So if you're getting high dividends, some of the investments we make are leveraged so that you're not going to get dividends or repayment of capital right away. But they're more focused on the exit versus dividends. So it really depends on the scenario. So, but in general, if you haven't used the lifetime capital gains exemption, it's a considerable advantage. And we're almost done.
Yeah.
And we're going to open it up to questions, but these are the key takeaways.
Yeah, so the private company investments, definitely have their tax advantage rates, and I think some of these products will definitely help you get there. And then non-residents also have preferential rates with the treaty. In terms of Canada, what you pay in home countries is a separate matter. And then the lifetime capital gains exemption is obviously the best tool people have to make on your return.
Excellent. So we're going to open it up to questions. Yes, Jack. So we'll give the mic. Sorry? Oh, this is not tax advice. You cannot.
So a friend of mine is looking at the lifetime capital gains tax advantage. If it's through connected corporations to the individual, is that considered possible, or does it have to be direct to the individual?
It has to be direct through the individual. Individuals do have some other tax planning opportunities. It's something we haven't really talked about here, but if it's made through a trust, sometimes that trust can have more than one beneficiary, and each beneficiary can have that lifetime capital gains exemption. So there are different ways that investors can use more than one exemption.
So a family trust would work.
A family trust works, but it has to be an individual selling their active business asset. It can't be the corporation.
Okay.
If you want to sell a corporation, if you want the corporation to sell, you have to sell the holding company, and that's not something that people typically want. And you probably don't want to sell your holding company because you probably have a whole bunch of other assets, and that holding company would have to meet the 90% test as well. So that can be costly trying to reorganize that, and I don't think people are really looking to sell the holding companies.
Unless it has a single asset.
Yeah.
And which is the structure we use. So our holding companies it's an independent holding company that invests in that opco, and we don't taint it with other investments.
Yeah, that's
would
fine.
Would that qualify?
Yeah,
okay.
If you would sell both the holding company and the opco, and then you would sell the holding company that owns the opco. That could also be amalgamated on sale, which is an option too, but not necessary if you're selling just a pure holding company.
Does that answer your question? Great.
Pretty heady stuff. My question would be, if we invest in whatever product line that Aura is offering, how much tax advice or tax opinions come with those investments? And should you come with your own tax accountant to review the whole deal, or is that part of the service that Aura would offer?
No, the answer is no. We provide no tax advice. So you're liable, or you're responsible for your own tax planning.
Call you, I guess.
Yes,
absolutely.
Please call me.
Yes. And simply because every deal is different, every situation is different. Sorry, Cam.
I think you do.
Clarify something.
Yeah. I'll share this just in case.
Pretty quick. The lifetime capital gain exemption, that applies to more than one transaction during the lifetime of that individual, right? Just wanted to clarify that. Like we have 5 deals, they all get the benefit of using that arrangement, right?
So you're asking if you can use that more than one time? No, it's a like in the lifetime word, it's one time per investor. Your deals may have different capital gains where you might make a gain of 400,000 on one deal, and you might make 900,000 on another deal. It's a lifetime of $1 million, and it actually does go up over time. It's indexed to inflation, but occasionally, like with this budget, it's going up to 1.25 million. So you would be able to combine deals to get to that 1.25 million, but you wouldn't be able to multiply it yourself.
But you could use it on multiple deals. Yeah, you could use 100 today and 1 million tomorrow. Yeah.
Just a quick one for the engineer. I didn't fully understand the difference. Your dividend and return of capital, who defines what you're paying back? Can you define it yourself, or does the company define it?
I think you're asking who defines the return of capital, and I think that's the corporation that defines how they're going to make the distribution back to the investor.
Okay. And
Yeah.
you have to decide between
Yes, it would be the board of directors of that corp, which we normally control, but not always. In instances which, for example, the active scale deal, which we closed this year, a co-investment, we don't have a board role. So we can't influence the board. We're a board observer. But that was one of the questions. Is there a minimum dividend policy within the agreements or not? And we did push for that. But it's just logical for any board to repay capital first. There's no advantage to the corp not to repay capital first.
There was some mention of real estate owned by the business, and was there some, we just want to understand that nuance there. Does the real estate portion of it comes out of the 90%, or is that's not considered active part of the business? And then my second part is, if you do a sale, the real estate portion doesn't qualify for the lifetime capital gains exemption?
No, so you're asking whether or not real estate and taxable Canadian property, I think, qualifies for the lifetime capital gains exemption?
No, if owned by the business. So
Yeah.
I thought there was some nuance where if you have an active business, the portion of the business that's real estate. I guess there's two questions. One is, did that factor into the 90% formula? Yeah, go ahead.
Yeah, so it depends if it's like an active business with the real estate. Like there are different rules about how many employees you have and if like the real estate business itself is part of the active business. If it's ancillary and you just own like a warehouse or something like that, then that might not be part of. That might disqualify the investment because it's your whole balance sheet of the shares that you own. So if you own company X and it has some inactive real estate, like some passive real estate, then that could disqualify that investment qualifying for the lifetime capital gain exemption.
Right, but let's say it's the head office, like it's corporate real estate they're using for the active business. Is that not disqualified?
It depends. The head office could probably be part of the business.
So is it better to separate it? If the business is going to purchase real estate, is it better to separate the investment in the real estate into a new holdco?
Yeah, I would say so. I think having it in a separate company makes sense for a variety of reasons.
Yeah, especially in case you decide to rent out that property, so you're not stuck with it and becomes a rental property, which may taint your overall qualification.
Okay, and then upon the sale, does the real estate portion of it, you can still get, if it's considered part of the active business, then you would still get lifetime capital gains exemption towards the real estate portion, or no?
No.
That's like exclusive.
No. Did you get, can the real estate owned by the corp take benefit of the lifetime capital gains?
So you're selling the shares of the business. It's like it's whatever the business owns, and then your capital gain realized on the whole business. So
So it could.
It could, yeah.
Because they're active and you meet the 90% formula, then technically the real estate portion could also
Yeah.
benefit from the.
But you're getting it when you sell, not when you sell just the real estate. You get it when you sell your shares in the investment. Yeah. So.
Perfect, thank you.
Yeah.
Yep, there's Jean.
Just a hypothetical transitional question. So the capital gains increase, and I think the lifetime capital gains exemption changes have not passed Parliament yet.
Yes.
Parliament is in this bizarre state of dysfunction right now. There's a risk of prorogation. So if the government does prorogue or call an election, what happens to people's tax planning for the next couple months and into next year? That's probably chance.
That's a great question. The question, in case it wasn't heard, was what happens to people's tax planning and transactions now if the capital gains increase is not passed by a transitional government. Right now, what you have, it's like substantially enacted, and so the CRA wants you to play with the game as if the rules have passed. Even the tax software hasn't really captured the new rates because it's not actually passed, so we're in a kind of a holding pattern. It's kind of a weird situation, and it makes everybody uncomfortable. But what's recommended is you plan as if it was made, and you have to withhold the tax on those transactions in 2024 as if they were enacted. And another complicating factor is how do you pay the tax if my tax software hasn't captured the 67% inclusion rate? And the solution now is to use it as a 2025 installment and to have the money in the CRA's bank account, your bank account with the CRA, and then it gets transferred. You can transfer it later on, but if it's paid now, you won't accumulate interest and penalties for underpaying your taxes.
Sorry. It's not us. So, yeah, what I'm learning, I'm sure some of you have done this to your kids when you tax their ice cream, right? So you take a lick. So what we should have done is taken half or 54%. That's what I'm learning from all this. Yes, Peter.
Well, you can probably hear me anyway, but do all PE gate investments return this tax structure benefit to the investors?
We try to, as much as possible, yes. So we do have a portfolio that invested in real estate that we moved that portfolio into, so that wouldn't qualify. But yes, we do our best. And we understand this from a seller's point of view. They want to use the lifetime capital gains exemption, and we're friendly with that because then they benefit from it, and hopefully we do as well from a valuation point of view. It does pose risk to us though, because buying assets is a lot less risky than buying shares of a company because you're buying into the liabilities. So when we think, for example, the one of the pet grooming deals we're looking at, he does have some liability to CRA, so that's definitely an asset purchase. And if we do buy assets based on some legal advice, funny enough, CRA can go after the assets that we buy if he owes money to CRA. So have you heard of that rule with the CRA?
Yeah, it's CRA wants their money, so CRA wants their money, so they will go after the assets. So there is that to be made aware of. But yeah, asset deals are generally easier for investors, but you have to assume the liabilities in the equity deals, and that's a risk, but it has that tax advantage. And so it's great that your products are structured in such a way that they can capture these plans.
Yeah, and on that deal, some of you invested in the pets, the latest raise. That's one of the delays in closing that acquisition is he's got significant liabilities. So we're being really careful with that transaction. We're not pushing it forward because of the liabilities to CRA and his landlord and so on. So whatever we do, we're extremely prudent, and that's why we only try to bring vetted deals that we are comfortable with. Other questions? Yes, Jean has another one.
I could just yell. Yeah,
Okay.
maybe one for Era. When you structure your transactions and you have a choice to pay income through dividends or to not pay income like a growth company, increase the valuations on sale, the seller would get capital gains treatment under the exemption, how do you as PE Gates would decide from a tax planning perspective how to structure stuff? Or do you have a similar approach to all your transactions? The buyers would know coming in?
So you're saying, how do we decide whether to pay a dividend or withhold the capital? Accumulate it. So we cover that up front in our offering memorandum. What is the goal with this investment? And we do clarify whether we're going to keep capital within the business for growth or not. We generally prefer to pay dividends or repayment of capital. So that's our interest. A lot of our investors are investing for that. And we have a scoring that says, is this a hold growth investment or is this a dividend play? So we try to cover that up front, and it's not the same for every investment. Great. Any other questions? So thank you, Jonas, for being here and for enlightening us with these complicated rules. Again, not tax advice, but he's available if you want to ask any more questions, and we're here as well. So thank you all for coming. Thanks, Jonas. Yeah.